This week's 1044 is brought to you by Chevron Delo 600 ADF Ultra Low Ash Diesel Engine Oil. It's time to kick some ash. We just rang the bell on the new year, so what's in store for trucking in 2022? Hey everybody, and welcome to 2022 and the 1044, a weekly webisode from the editors here at CCJ. I'm Jason Cannon, and my co-host on the other side is Matt Cole. Over the last nearly 2 years, we've seen a seismic shift in consumer spending habits that, when bundled with a number of other factors, have turned the transportation industry on its head. Just about every corner of the industry needs more trucks, more trailers, and more drivers, but nobody can find any of them. We currently find ourselves in a freight market that is equal parts interesting and challenging.
The last 18 or 19 months have been unlike anything the industry has ever seen. Sure, we've had to navigate natural disasters like hurricanes and floods before, but being in the crosshairs of a global pandemic during a generational supply chain crunch was a new deal for all involved.
We spoke with Jim Nicholson, Vice President of Operations at LoadSmart and a former Schneider executive. And Jim's seen a lot of things, but 2020 and 2021 were completely new ball games. But now that's behind us. What's in store for early 2022?
As we look into 2022, continued strength in demand, certainly through Q1, that first half of 2022. Q1 most likely will see some seasonal impacts indicative of historical Q1, January, February cycles that do taper to some extent coming out of the holidays. But strength going in, through Q2, definitely through the first half of the year. Expectation, there's more question marks as we get into the second half of 2022, as there's more headwinds that have emerged that certainly really haven't been a factor over the past 18 months.
Inventories are among the headwinds heading into 2022. Despite the fact that most retailers were able to build respectable inventory levels to survive the holiday season, it could take a while for that to get back to historically normal levels. But shippers and carriers don't have the luxury of focusing just on recovery. They've both had to rethink their methods as a preemptive strike against future supply constraints.
Certainly inventory. Inventories have been a continued challenge and struggle for global shippers, right? So with the supply chain disruption and even more recent media attention that we've never seen in this space, just-in-time lean supply chain management has challenged shippers throughout this very disruptive event that was COVID. So over the past year, 6 to 12 months, more of the large organizations have certainly focused on just bringing back inventory online. It's been challenging because consumer spending was so high. But really indications now of the large big box retailers throughout this holiday season is successful building inventory despite rising costs of transportation. But we see that's a positive sign that as we give more time in the first half of next year, we'll see continued inventory build. That longer term, shippers will be evaluating how they're managing inventories differently to mitigate the risk of this happening again.
Stimulus money has been long gone and spent, but for the most part, consumer spending has remained at a healthy level. But 6+% inflation is breathing down our necks, and it's stressing consumer health. Jim shares his thoughts on how that might impact freight right after this word from 1044 sponsor Chevron Lubricants. Protecting your diesel engine and its aftertreatment system has traditionally been a double-edged sword. The same engine oil that is so essential to protecting your engine's internal parts is also responsible for 90% of the ash that is clogging up your DPF and upping your fuel and maintenance costs. Outdated industry thinking still sees a trade-off between engine and emission system protection, and Chevron was tired of it. So they spent a decade of R&D developing a no-compromise formulation. Chevron Lubricants developed a new ultra-low ash diesel engine oil that is specifically designed to combat DPF ash clogging. Delo 600 ADF with OmniMax technology cuts sulfate ash by a whopping 60%, which reduces the rate of DPF clogging and extends DPF service life by 2.5 times. And just think what you can do with all the MPGs you're going to add from cutting your number of regens. But Delo 600 ADF isn't just about aftertreatment. It provides complete protection, extending drain intervals by preventing oil breakdown. Before, you had to choose between protecting your engine or your aftertreatment system, and now you don't. 600 ADF from Dello with OmniMax technology, it's time to kick some ash.
Ever since June, July 2020, consumer has been very strong, right? Now with rising inflation, granted, we've really seen a resilient consumer throughout the duration of 2021 and Q4 here, with indications of very strong seasonal consumer buying behavior leading up until the Christmas holiday. That certainly could be challenged as inflation rises. At some point, you certainly would expect that's going to put some pressure on the strength of the consumer, and most likely we'd see the pace of tapering from the Fed and monetary policy probably accelerate. And then some other factors, certainly on the supply side, backlogged truck and trailer deliveries due to OEM production issues and challenges over the past year. We'll see equipment hit the market, but we've also seen a very resilient truckload carrier market as both the for-hire fleets and tractors have really accelerated in Q4 despite the challenges and headwinds of driver pool as well as equipment, right? So potentially you see some capacity coming back online that simultaneously with some of the challenges on the demand side could create some pressure on the strength of the market and potentially bring some more normalcy as we move throughout 2022. The first quarter is right around the corner here, right? So the consumer has been extremely resilient to inflation over the past 2 quarters, really. So it's hard to say you're going to see some serious impact of inflation as a headwind to consumer spending in Q1. Most likely you'll see some impact in Q2, but we see more of a back half of the year. So again, difficult to say. We'd say we expect strength going into the first half of next year. So don't anticipate a short-term impact here, but again, over time and some of the other headwinds coming into place, if there's when that consumer pulls back a little bit from some of the spending behaviors they've done, we certainly will see some impact on the freight markets.
The improving capacity Jim mentions could bring with it a measure of normality as we move through 2022, and that would probably be welcome news for shippers who have seen contract load tender rejections over 20% for most of last year, and for carriers because it means contract rates are going up.
We expect contracted rates to increase year over year, 2021 to 2022, just based on the pace of rate increases in the market has continued throughout the duration of this year. So contract rate increases will allow service providers to accept more of those contract tenders that over the past 18 months have been thrown into the spot market. So we've seen this year through the OTRI, the tender rejection index, some reduction from a peak of around 30 down to south of 20 right now. Now that still remains very tight, historically speaking. But as you see continued pressure there and tender rejections potentially, dropping below 10, then you certainly get more into a more normalized freight market environment where carriers are accepting those contracted tenders, the commitments that they offered. We also do see some changes in how shippers are procuring capacity on the contracted side, which we're really excited about. There's certainly a silver lining is the accelerated change in behavior from a very much a reliance on 12-month static agreements, and then we saw shippers unlock more of the short-term contracts as we've gone through the last couple of years, but more flexible contract arrangements. We've seen a lot of acceleration and traction that gives shippers more predictability within the capacity while mitigating some of the risk of spot market dependency through disrupted markets. So we're seeing some acceleration and adoption of more of these contracted pricing opportunities for shippers.
While rejections may normalize and contract rates improve, this elevated level could be the new normal for a while, which is good news because it signifies a more healthy freight market.
Historically, the low point here is low single digits. That's not a healthy market environment. That was really what we saw back in March or April of 2020 when you saw the depths of the immediate COVID impacts. 2019 was a challenged market that really hovered in the mid-single digits. I don't think we approached those levels in 2022 by any stretch, but we expect to move below where we're at right now. As we fast forward 12 months from now, and right now we're right around 18 to 19%.
The pandemic accelerated a consumer shift toward e-commerce. It basically did 6 years worth of prodding in 6 months. That's reinvented many carriers' business models, and we saw that through several trucking fleet acquisitions in 2021. Jim expects to see more of that this year, along with ongoing deployment of technologies that streamline business operations.
I think there's certainly some interesting M&A activity amongst the large truckload carriers, one being Knight-Swift, acquiring some of the LTL side. So there's a race to the final mile that's interesting, and really it's adapting and morphing our company, these larger, more incumbent traditional providers into certainly different providers that can offer more of the final mile and direct to consumer. We'd expect that to certainly continue, but it also really allows for more opportunities for shippers to look at optimization in the ways that they arrange their supply chains, and really being more creative, leveraging data to be able to orchestrate and design their supply chain, really with the increase in e-commerce and direct-to-consumer activity, to leverage different types of warehousing structures and distribution to distribution, skip-level zoning, lots of opportunity to leverage data insights to really optimize their supply chains.
Matt mentioned earlier that we've seen freight imbalance before, usually on the heels of storms and natural disasters. So while we've never been in this specific situation before, we've been in situations like it.
If you reference back historical years, 2018 would probably be the most indicative. And the reason I say that is 2018 really coming off of 17 with the disruption from the hurricanes. Started off in the first half was very strong, and then you saw some tapering as you got into the back half of the year. So I'm not comparing the levels of disruption here, but I'm comparing the trends. That 2022 could replicate or compare more closely against 2018 than any other historical year, just in the trends there. So we do see that there's a likelihood that this cycle could start to run out of steam, and that's not saying this is going to pull back into a fully normalized marketplace, but we expect that cycle to really begin in the second half of the year. 2023, certainly it's difficult to forecast out that far, but we expect this strong cycle to be a 2-year, 24-month cycle that we'll see some tapering in the second half of the year.
That's it for this week's 1044. You can read more on ccjdigital.com, and as always, you can find the 1044 each week on CCJ's YouTube channel. And if you've got questions, comments, criticisms, or feedback, please hit us up at 1044trucking@gmail.com or give us a call, 404-491-1380. And until next week, everybody stay safe.